Welcome back to another week of the Educated Homebuyer Live. This is typically where Josh and I, update you on the economy, answer your mortgage and real estate related questions, but you'll notice something. Josh isn't here, at least at the moment. That's because Josh is an amateur when it comes to podcasting, videography, everything, just technology in general. Josh is an amateur. He's trying to restart his computer, so he will be here in a moment. So while we do that, got some questions, start putting them in the chat, and then we'll do as we always do and update you on the economy. But I appreciate everybody being here. Let's get started, guys. So if you have questions, put them in there. What we're going to do here momentarily is we're going to update you on the economy. In fact, I'll just go into the slides now. Josh can add himself when he comes in, and we'll go from there. So what this chart shows is inventory. Every single week we start with inventory, and at the moment it shows to still be increasing with 605,000 single-family homes unsold on the market at the moment. Now, that's up 1.7% for the week and 39% more than last year at the same time. Something to keep in note, though, inventory is up everywhere in the country. Most states have about 30% more homes on the market than a year ago. Now, we're going to look at Orange County here in just a minute, and we're going to look at Huntington Beach as well, as we always do. But the majority of listings seem to be focused in Florida, California, Texas, Arizona, Georgia, with the Northeast area still being on the lower side. A lot of you guys comment every single week saying, hey, I live in, Pennsylvania, I live in New Jersey, whatever. Inventory sucks. Understand. And that's essentially what the data is also showing. But let's do this. And this kind of, this is a chart Josh wanted to put in here from Resi Club. So the first chart that we looked at, this chart here actually comes from Housing Wire. It's Altos's data. But the next chart that we look at, this chart actually comes from Resi Club. So it's essentially telling the same story, exactly what we just talked about. I said inventories higher, 39% higher than at the same time last year. And this is essentially what that shows, right? So we're showing the shift between May of 2019 versus May of 2024. So this actually shows inventories down 39% from that period of time. Just happens to be the same number where we're up year over year. So you can tell where we are, comparatively speaking versus 2019. Most of the country is still below those pre-pandemic levels. Outside of, what do you see? Texas, when you look at that chart, Josh. Josh is here, by the way, guys, if you didn't notice his big head in the bottom of the screen.
My technology is back working. I just thought, Jeb, since I had to go solo last week, I'd let you go solo this week. And then
I could have done it, Josh. This show existed prior to you ever being a part of it. And I can make it that way again if you keep acting up. You understand?
We'll see. We'll see what the audience says.
Yeah, the audience, Josh, this is Jeb's show. It's not the audience's show. Come on. No, kidding. Appreciate you guys being here. So this, again, shows the one-year change in active housing inventory for sale between May of 2023 and 2024. So you can see this essentially goes with what we started the show with, that inventory here in California is up about 38, 39% year over year. But, Florida, 70%. Seattle, Oregon, Washington up 52%. Arizona 68%. So those seem to be the big ones. Is that Vermont, Josh, up there in the right side there at 32%?
The Northeast is not my.
I think that's Vermont, New Hampshire, right up
this part.
So I think that's right. So that essentially all tells the same story. And this, again, just housing inventory from Realtor.com. So inventory comes from a couple of different sources, but essentially it's all telling a similar story, that it's increasing, but it may be leveling off. And we're going to talk about that here more as we dive into tonight's episode. So active inventory here in Orange County sitting at 2,712 homes. You can see that's the highest level that we've been. We didn't start aggregating this data until the beginning of 2023, so we don't go back into 2022. But essentially, these are the highest levels that we've seen since about December or so of 2022. Huntington Beach sitting at 162 active homes, which was basically a 10% increase week over week, Josh. But as you can see from the data, we've been here. In fact, we were here most of last year at these numbers. but we haven't been here since December of last year. So it's been about 7 months or so. No, not that long. 6 months or so since we saw those numbers. But inventory looks to be increasing a little bit.
Well, it was
The weekly
interesting that
change.
in January, Jeb, we saw Orange County start trending up, and Huntington didn't follow along till what, about March, but it's kind of turned the corner here.
And even when I look at this, I go, is it really following along, or are we just, I mean, we are at the time of the year when inventory starts to peak, guys. I mean, this year's a little bit different. Rates have been higher for longer. It's allowed, unsold inventory on the market to stay on the market longer. And inventory's, growing because of that. But this is time of the year when things start to slow down. So if rates start to trend down, we might see another increase in inventory. If rates go higher, we might see another increase in inventory. But if they just kind of bounce back and forth, it's going to be interesting to see what happens with that. The weekly change is what I always like to pay attention to. We went from 594 to 604. We're talking hundreds of thousands with that number. And we're essentially sitting at the highest level of inventory on a weekly basis, or looking at week over week, that we've seen since prior to the pandemic for the most part. Going back to, 2020, early 2020, maybe 2021. Weekly new listings. So weekly new listings, 63,000 new listings unsold this week, plus another 13,000 that were immediate sales. That's 10% more sellers than last year at this time. But if you look at the trend new listings chart below, seller growth appears to have leveled off. So again, we talked about that earlier. Less new listings coming to the market. So how is inventory growing? Well, it's growing because the homes that are coming to the market are sitting on the market longer, and therefore they're not getting purchased quickly. Inventory grows because of that. So
Jeb, that dip that we're seeing right here, if you look on the other two colored lines, that looks like we get that every year. What is seasonal?
Memorial Day?
Is Memorial Day?
Yeah, that's what I'm thinking. Yeah, probably Memorial Day week somewhere in there causes that big dip in inventory. It'll be interesting if that's actually the case. And we see, you can see, years past this, we're getting close to the peak. What is the red one there in the middle? Is that last year, or is that 2022? 2022 is when we first saw that rates were continuing to rise during that period of time. And, we didn't see the peak until late in July. We're getting pretty close to, or a month and a half off from that. So it'll be interesting to see if similar story this year. Weekly new contracts pending, 406,000 single family homes in contract right now. That's 1% more than last year at the same time. And also just 1% more than a year ago. And then it takes us into median price of new contracts. The median price of single family homes on the market is $453,500. That's barely 1% increase over last year or 2022. The median price of homes newly in contract is sitting at $399,000, which is 5% higher than last year at this time. And Mike Simonson says this measure of home sales prices has been bouncing 3 to 5% over the last year. So new contracts, new sales, about 3 to 5% year over year. Typically speaking, price reductions up to 35.1%. So meaning just over a third of the homes on the market have to do some sort of price reduction prior to selling those homes. So Josh, what are we looking here with the actual Case-Shiller home price index?
So that's the index, but if you look to the gray bar, that's Goldman Sachs, their projections going forward. So Goldman has actually been one of the more aggressive projectors. They're on the high side, but they do believe we're going to continue to see that 4.5% for the next 2 years. The good thing with Resi Club, I think he does it about every 6 months. He goes and looks at everyone's forecast, and we are getting here into June. So we'll get the mid-year updates from all of the 10, 12 major economic forecast groups. But Goldman just updated their number, and they see it slowing, but definitely staying solidly above the long-term trend, or at that long-term trend. With this, just wanted to throw a couple of charts in here to show you. This one comes from John Wake. He's an analyst out of Arizona, but showing that the supply of houses grows more slowly than the supply of gold. The important point there, the takeaway is that the house prices are extremely sensitive to increases in demand because supply increases extremely slowly. So we saw during COVID, the massive spike in demand, more people with really low interest rates able to buy. And we've seen zero or close to zero response in terms of supply increasing. Explains a lot of where we are with prices. There's another look, Jeb, at the same data, total housing inventory per person. So if we go back in 2008, 1.17 units per household, and now we're down to 1.12. It's only a 0.05 difference, but you see that the trend has been pretty consistent over the last 16 years since the great financial crisis. Never really picked up on the building, and it hasn't kept pace with population growth. But maybe, Jeb, what we'll see as population growth continues to slow, it'll just even out over time. Share of households planning to move starting to recover. We showed the chart. I don't know if it was last week or 2 weeks ago, Jeb. We went through that chart just showing that people are staying in their homes longer and have less plans to move. It looks like it's recovered here a little bit recently. New York Fed Consumer Survey, the average probability of changing primary residence over the next 12 months has ticked up a little bit. We'll see how the market works with that. We like to go through different measures of inflation for you guys. One of the big drivers of inflation post-COVID with the supply chain issues was used autos. Used autos are getting a nice correction here and actually outright deflation, and is offsetting some of the other figures that we are seeing there. Jeb, did you skip 2 or you skip 1? No, we usually do the chart here later, Jeb, but I kind of wanted to start with this because we've seen a nice move down in the 10-year this week, and we're going to go through the data of what happened to cause that, and then what comes next and what comes next in terms of data and how that's likely to impact what happens here. So we've had this uptrend here, the red channel there going back to what was it, December, January. We've been tracking, watching, are we going to break out the bottom? Or we're going to run back to the top? So we had a nice breakout about 2-3 weeks ago, and last week ran right back into the middle of it. So we are looking, Jeb, at a more convincing breakout here. The yellow line at the bottom, that's the 200-day moving average. That's a longer term indicator. If we break below that 200-day moving average and remain there, not 1 or 2 days, but you stay there for 2, 3, 4 weeks, it tells you that it's a longer term trend change, and you could see continued movement in that direction. Anything else you wanted to point out on the chart right now, Jeff?
Not necessarily on that one, but someone a couple weeks ago asked about the weekly chart. What does a weekly look like on that? And the weekly is also a breakout of the bottom at the moment. Now, the week hasn't closed yet, right? So tomorrow you got jobless claims. Friday you have NFP, which is really the big mover there. If it breaks out and stays out of that channel, that's a good sign for mortgage rates over the short and even long term for that matter. So, if you want to see that breakout continue, you're really hoping for the NFP number to be rather dismal on Friday.
Hey, I doesn't even have to be dismal. Just have to continue trending.
No, dismal. Let's get
dismal. Will move it quickly.
Let's just get downright
home buyers would like. But if you look at this, we got 5 daily candles in a row, firmly red, and we went from 462 down to 427 or so in 5 trading days. That's a pretty big move. Normally, we would be concerned that it's too much, too fast, but that NFP data can actually move it. So let's look at what happened this week. Monday, we got ISM manufacturing and then prices paid in that same study. Both of them came out significantly under what was expected. So that got us kicked off for the start of this week. Tuesday, we had JOLTS, job openings, labor turnover. So they were expecting, you see the green box there at the bottom, expecting 8.37 million open jobs. It was 300,000 light of that. And you're going to see this continuing trend on these charts of this green downward trajectory. So less and less job openings. So with 8 million job openings, if we go back pre-COVID, that number was 6.5. So it is still an elevated number. This is not saying, hey, we have a terrible jobs market. We're saying we don't have that jobs market that is strongly in favor of job seekers and job changers the way that it was. Today, we got S&P Global Services Purchasing Managers Index and the ISM non-manufacturing, both of those right on trend and slightly above. And the market shook that off primarily because those were the 2 important ones. They have the gold stars there. But just below that, we saw the employment figure came in light, and then the prices paid came in light. So sort of offset. Normally it wouldn't offset. The market would not have improved the way that it did today. It tells you that market participants are looking forward to NFP and kind of positioning for that dismal report that Jeb is hoping for. ADP on Wednesdays, the Wednesday before the first Friday of the month when we have non-farm payrolls, ADP releases their monthly figure, also came in light, projected at 173, came in at 152. Again, that green downtrend from that peak of COVID where we were getting big payroll reports. You've seen a pretty consistent downward trend, and we're getting back down to a fairly low level. Sub 200,000 job creations in a month is below what is just sort of replacement for population size. So we're looking forward to the teal box here on Friday. As you can see, the last month we came in light of the purple, which is ADP. But prior to that, it has been pretty consistently beating the ADP numbers. Couple reasons for that is because it also includes government jobs. ADP only has private jobs. But when you're looking at this, also, Jeb, there was another piece, and I completely lost what the other thought was here. But ADP does its actual payrolls, whereas the Bureau of Labor Statistics, there's two surveys to it, and one of them, they do a birth-death ratio, assuming how many jobs or how many businesses are being started. And when you have a downturn, they're generally overestimating, and when you have an upturn, they're underestimating. So still a chance that despite the underlying economy and jobs market moving in the right direction, that the Bureau of Labor Statistics could come out with a hot number. This is what we've been looking at. So the projection, Jeb, is for 185,000 jobs. This has also been trending down. If you're in the market and you have a solid job and you're not worried about losing your job and you want to buy a house, you are hoping for as weak a report as you could possibly see here. In Jeb's words, the dismal report. Jeb, we had talked about this earlier. It's a big week coming up. So not much on Monday, but on Tuesday, we have a 10-year auction that can have an impact on mortgage rates and the market. It will be interesting to see in light of what has happened this week and with what will happen on Friday with NFP and the market reaction of what that looks like. We also get CPI on Wednesday. We get a Fed decision on Wednesday. And then on Thursday, we get PPI. But the big one are going to be NFP Friday, and then Wednesday, CPI and a Fed meeting. And really, the only thing, Jeb, that's going to matter with that Fed meeting is what they say in reaction to that data. And those prepared remarks are probably already prepared. The interesting part is always when he goes and does the press conference, and the journalists are going to have a lot of data, a lot of things to ask. So it will be a very interesting press conference next Wednesday. This one here, Jeb, I thought was interesting. Bloomberg has a natural language processing model that they have trained to read all of the speeches, press conferences, everything that Fed board members have. And they then equate that to a number of, are they speaking in hawkish terms or dovish? So we had seen a nice downtrend kind of towards neutral towards the beginning of the year, but it's ticked back up. In light of this recent data, it will be interesting to see if that changes over the next coming months. What does it mean for what's most likely at this point in time? So June meeting next week, July meeting, late July, basically saying we're going to be 80% chance we're still going to be exactly where we are. But as of now, 80% chance of getting a cut in September. Wouldn't likely to get two of them back to back, but expecting either September or November that we'll get a 0.25%, and now pricing in January or December or January for another 0.25% cut. So you guys have seen, we show this every week. It changes a lot based on what's going on with the market. What does it mean for you if you're in the market? 7.03 on a 30-year fixed. That's about where we were before we saw the recent uptick in rates. FHA 6.55. And as always, definitely on the FHA, but most likely on a 30-year fixed. Well-qualified borrowers in that highest tier, 760, 780 credit scores, bigger down payments will be able to do a little bit better than that.
Good stuff. So hopefully you guys found some value in that. We actually published the episode this week on the Educated Homebuyer talking about refinancing. So I know many of you guys are first-time homebuyers. You're not refinancing. You're literally just trying to get your first home. But for those that are considering refinancing, it's kind of a mistakes issue, things to avoid. So if you're interested, you know somebody that's thinking about refinancing, we're really kind of walking you through the basics there. So go over to the Educated Homebuyer channel, check it out, or listen to it on the podcast. Either way, we appreciate the support. But we're going to do what we always do, and we're going to answer some questions. What we got? We got a couple people in the chat. Said my mic is acting up. Mitchell said that earlier. I don't know if that's still the case, but if it is, let me know. I need somebody to buy me a new mic. Who wants to buy Jeb a new mic? Anyone? Anyone? Any takers? No takers. Okay, I'll buy myself.
We need a super chat, like a $300 super chat.
No, I think I need to buy a new mic. We've had issues with this mic multiple times, and maybe it's run its course. It's a couple years old at this point. So we've got Javier saying I got something in my nose. So Javier, are you watching this thing on like an 80-inch TV or what? What are we talking about here? Do I have something in my nose?
He's zoomed in on you.
There we go. I guess I shouldn't do that prior to going on the show, huh? People see it. Kidding. But anyway, if I had something, I appreciate you pointing it out. And if I didn't, you got me to wipe my nose and you won whatever bet you had going, probably with Kyle. Hey, I bet I can get Jeb to touch his nose and you won. But anyway, let's see. Not a lot of questions here, Josh.
Jeb, in addition to the famous Javier, we have the famous Alexis Brown, great realtor in Memphis. So any of you looking in Memphis, Tennessee, Alexis can help you out there. Glad you stopped by and checked out the show tonight, Alexis.
All right. Well, there you go. How do we know Alexis?
Through Vetted VA.
All right. There you go. Easy enough.
A former San Diegan, for some reason, decided to relocate to Memphis, Tennessee.
People do that. People do it. A lot of them come back, but people do it. All right. What's this live about? She asked. This live's about educating.
Everything.
That's what it's about.
Answering questions.
All right, here we go. Let's answer some questions here, Josh. So let's go with Drew. Drew asked, "What's ADP?" I do too many football fantasy drafts, so I have a different meaning for it. So ADP is basically the payroll processing company. I don't know what ADP stands for. Do you know?
It's data processing.
Data processing,
automated data processing.
Yeah. Anyway, most employers have some sort of payroll that they use, and ADP is one of them. And basically, what they do is they look at that data and aggregate that data and figure out how many jobs are gained, lost, whatever during that period of time. So that's all it is. But BLS on Friday is a little bit different, as Josh mentioned earlier. It takes into account government jobs and some additional things that ADP does not look at.
Yeah, you don't want to know how the BLS does it. The ADP
they make it up.
Actual data from payroll companies, and they're just aggregating it. The BLS says, hey, we're going to do a little voodoo over here and throw out some crazy numbers.
All right. So Alvin has a question, says, my DTI maxed out, have 4 rentals, cash flow $3,000 a month. Once all bills are paid, can my $3,000 lower my DTI, or does that work to low my DTI? I'm looking. Okay. So Josh, let's back up because the question's a bit hairy there. How does rental income help you or hurt you in qualifying?
With a rental property that is shown on your tax return, we're going to do a cash flow analysis of the Schedule E on your tax return, which can be better, which can be worse. Some people really just have a ton of expenses on there, and they weight that really heavily, and it looks like they lose money when they actually positively make money. Paper losses like depreciation, you can depreciate a rental property, we can add that back in. So from that, we're doing the cash flow analysis, and we're going to determine, is there positive cash flow, which gets added to your income? Is there negative cash flow, which gets treated like a debt, like an auto payment? And the only thing that would be different there, if any of those 4 rentals that you have, Alvin, were bought in the last 12 months and we haven't shown them on a tax return yet, then we're going to need to get the lease, give you 75% of the rents from the lease. If we say we're getting $1 million a month rent on a condo in Boca, we're going to have to do a market rent survey and show why it is worth that kind of money. And I guess really, Jeb, the only wild card in there that we're seeing a little bit more, if you have a property that's a short-term rental, we cannot use the short-term rental rates until it shows up on your tax return. They won't allow us to do Why am I drawing a blank? There's actually a database where you can look up market rents for short-term rentals. So a lot of the non-QM lenders, alternative type lenders, will allow you to use that, but we cannot on a standard purchase. So it has to get on your tax return where you have at least a full year history of those market rents on the short-term rental.
All right, good. Darren is asking about Freddie Mac and buying equity loans, asking, is that, a good idea, bad idea, and how does it differ from a HELOC? So if they were to buy loans, it wouldn't be I guess just answer the question. I guess what I was going to say is,
well, here's the thing. How would it help? Right now, there are lots of lenders that will make second mortgages, that will make home equity lines of credit. They all have their own guidelines. So if Fannie and Freddie's the one talking about it, if either one of them steps in, then they'll have a standardized set of guidelines that they say, if you underwrite to these guidelines, we will purchase these loans. So it makes for greater consistency. It makes for lower costs on those loans. So what some people are proposing is, hey, this would be great for the economy. We would be able to extract mortgage equity for all of these people who have great low first rate mortgages, and that would get pumped back into the economy and make it stronger. Well, we don't need a stronger economy. We've been talking about the economy being very resilient and resistant to Fed actions. So I don't know that it's necessarily a bad thing, but it's also not helpful or good at this point. I don't know of any well-qualified borrowers who are unable to go out into the market and get equity out of their home at this point in time.
Yeah, I mean, that just, again, pushes inflation up, right? I mean, more money spent into the economy pushes prices higher, which is essentially what the Fed is trying to avoid at the moment by slowing the economy. Love for Puppies is asking about 40-year mortgages. Josh, we have a lot of questions around 40-year mortgages. I guess you can address credit unions, because credit unions keep a lot of their own portfolio loans, so they don't necessarily have to deal with the guidelines per se, but I guess just talk about 40-year mortgages in general so people can understand why we don't have them already.
They don't meet the qualified mortgage guidelines, so they will never work for Fannie, Freddie, FHA, VA, USDA. But a portfolio lender that isn't concerned with it meeting the qualified mortgage guidelines, they can absolutely do that. So when Jeb says the credit union is likely going to keep that loan, if you're seeing a 40-year loan, they are absolutely planning on lending credit union funds, keeping those loans on their books. Most people don't realize this, but other than the biggest credit unions, most credit unions don't actually have a mortgage operation. They're going to broker your loan out like any other lender, or they're operating like an independent mortgage bank where they're going to fund it with credit union funds and then sell it off. So there are big credit unions out there that make their own guidelines, do their own stuff. If you're seeing stuff like 5 Arms, that type of stuff, then they generally are doing their own loans. If you see rates that look like they're well below the market, they're probably doing their own loans. We just got access, Jeb, to a new credit union that we can do correspondent close in our name in the state of Washington, and they're about 0.5% below the market and can do things that look like Fannie Freddie, but outside of the scope of Fannie Freddie. So some credit unions are lending their own money and can do their own things, but they are actually the exception rather than the rule.
All right, good. Mina, give a $5 super chat. Mina, thank you for showing up weekly and giving me $5. I appreciate that. It is very, I'm very appreciative. I'm grateful for that. David has no question, but he did buy in 2022 and said he found my channel during that home buying process, appreciates the information and insight, tunes in frequently via the podcast to keep up with the market. So appreciate you being here, David, showing up occasionally, dropping in, say hello and thanking me. I appreciate it. It's what keeps the channel going. The support, knowing that it helps, is actually why we do what we do. I'm going to ask a favor, though, David. You show up here every week. If you haven't done so, rate, review the podcast. If you haven't, it will help it. And for those of you listening at the moment, if you haven't liked and subscribed tonight, do us a favor and do that. And if you haven't checked out the other channel, which is The Educated Home Buyer, head over there and check that out. Again, all of that stuff just pushes it out, lets YouTube know, hey, people actually watch this stuff, and pushes it out to more people like you guys. Alexis followed up with a question, Josh, and is saying, if someone hasn't filed their taxes for 23, but it's filed 21 and 22, is that a problem?
Not a problem. because we're still within the extension period. So have a client right now, they are actually CPAs and they are on extension. They're buying a couple investment properties in your neck of the woods, Alexis, in Nashville. So your state, at least, Tennessee. And we had to get a 2023 profit and loss statement because otherwise we don't know. We have no idea what 2023 looked like, and we're halfway through 2024. So until we get past that deadline, what is it, October 15th, Jeb, is the extension deadline. Until we get past that deadline, we are okay with them not having it, but there's some additional documentation. So the P&L, and then we'll need a P&L through the most recent closed quarter for the current year also, just to make sure that the business is still generating the income that we're showing on those tax returns to qualify them.
All right. Good stuff. Let's see here. Platoon Daddy. I feel weird even saying that. I just bought in Missouri, $333,000 at a 6.7% with a VA loan. So first off, thanks for your service. People say don't buy right now, but I'll never wait for two political figures to determine the market. I'll buy now and wait it out 5+ years. So yeah, I mean, here's the deal. Josh and I always say you got to buy when it's the right time in your life. Don't listen to Josh. Don't listen to myself. We're not telling you to buy. We're not telling you to wait. It's really giving you the information, arming you so that you can make informed decisions. But, we always say you got to have a longer term time horizon. You got to have money in the bank. You got to be comfortable with the payment. You don't have to like it, but you got to be comfortable with it, knowing that, hey, if this is what the payment for the next 5 years, I can make it. I'm not going to be in a distressed situation. And, if you're doing those things, chances are you're going to be okay. We've told many stories over the years, people buying at the wrong time, and it's still working out. So it's not about trying to pick the top or the bottom. It's about buying when it's right. But appreciate
and having that long-term time horizon.
Absolutely, all day, every day. And Brandon, you're asking, should you buy now or should you wait a few months, years? The answer is the same. Wait for what? What are you waiting for? You waiting for lower prices? You waiting for lower rates? You waiting for both? Waiting for affordability to improve? Are you waiting for more inventory to come to the market? Are you waiting for a crash? I mean, these are all things that may happen or may not happen. And the probability of affordability improving substantially, prices coming down substantially, rates coming down substantially, all of those things happening at the same time is not realistic. It's just, it's wishing for the cake and eating it too, metaphor, if you will. So, just buy when it's right. Buy when it's right.
Jeb, we got an important question here that
we do.
Qualified answer. Huang Vo would like to know: $700,000 apartment, I'm assuming condo, in Huntington by the beach on PCH. Is it worth it for a 1-bedroom, 1-bath?
Is it worth it? Depends. $700,000 on PCH. I'm trying to think which one that probably is. There are definitely buildings downtown that I would consider at that price if it's the right thing for you. But what I will say anytime about a 1-bedrooms, have less demand. They're probably going to appreciate a little bit less than a 2 or 3-bedroom property. But the analogy I like to use is if you have like 100 people looking for a property and you say it's a 1-bedroom, right? You lose immediately half of that number. I mean, probably more than half of people that just won't consider a 1-bedroom for one reason or another. So it might fit your lifestyle. And if you're okay with that, fantastic. But I always ask buyers to consider, what does it look on the resale side? If you need to sell that property, if you have to sell that property, if you go to sell it, whatever in the future, are you going to be able to sell it, quickly, depending on the market? I mean, all of those things factor into that decision, or at least on my side. But, you got to make the right decision. But there are definitely condo complexes in Huntington Beach that I would consider a 1-bedroom at that price. 1,200 PCH is not one of them, if that's the building you're considering. 200 PCH, 200, 1,900, 2,000. Those are all complexes that are nice complexes. The one that I mentioned, the 1,200 building, that's on leased land. that creates another issue, right? So not only do you have a 1 bedroom, you've got leased land factored into it. So now your 100 people probably came down to like 5 that might consider it just because of that. So consider it all. More importantly, call me and I'll walk you through it. How's that? And we can actually have a detailed conversation about the property you're talking about.
Without everyone around the country going, I don't care about Huntington Beach one.
Exactly. On the fence. Gabe's on the fence. Gabe, get off that fence. It says, should I finish my basement? How can I calculate how much value a 600 square foot finished basement will add to the value of the home? So Gabe, here's what I would recommend. We don't have basements here. Well, there are a couple locally, but what I would recommend is calling the agent that helped you buy the house. And if you don't know one, I can reach out and send you somebody to, just have a conversation with, right? Obviously you're not trying to sell your house, but find somebody in your market that understands your market and talk to them. The other thing you could do is find a home that's similar to yours. If you're in a tract that has similar properties, similar comparable homes, and find one that has the basement and figure out how much that actually, that property sold for. What's the price per square foot on something like that? And then you might be able to take something similar and transfer it to your property if it's a model match in similar condition, all of those things. Or talk to an agent and let them run the numbers and tell you, whether or not it makes sense.
Jeff, let's go with this one. You have some recent experience with it. Andy has an assumable FHA loan. Does a buyer have to be FHA qualified to buy it? My loan company doesn't let me forget that it's assumable. That's interesting. I would think that most lenders holding those, I guess your servicer, they're servicing rights. They don't care what the interest rate is. They make money off of the servicing rights. So they probably do want to let you know so that someone else will take that over versus getting paid off and losing those servicing rights. But they will have to be qualified. It's not just, hey, anyone can take over your FHA loan. Any other insights, Jeb? You got our good friend George here is his home is listed, VA loan at an amazing interest rate. That's assumable. Have you got very far into it? Got any more info?
We're in the early stages of he for example, so FHA, when you assume that loan, you're going to be doing an FHA loan. So really simple, right? VA is another loan that is assumable. But the nice thing about VA is you don't have to be a veteran to assume that loan. That's a huge benefit for a non-veteran, because in the case of the property that I have listed at the moment, it is a 1-bedroom. So we've had less demand because of that 1-bedroom. It's also in a senior community, so you have to be 55 and older, and it's also upstairs. So take all of those things that we just added, and your buyer pool just went down to like a handful of buyers. But here's the caveat. He finance that property at a 2.25% VA 30-year fixed mortgage. So the buyer going in to buy that home can assume that loan, assuming they have the difference in the down payment to be able to pay, what he owes versus how much he's selling it for. Now, in some cases, you could get a second loan for that amount with a small down payment. That's an option. In the case that a couple of the buyers that we're talking to at the moment, one of them has the money for the down payment and may just assume the VA loan. So we're early in the process. I'm going to make a video about this deal once we get into it, because I want to document the whole process, because a lot of conversations around it, a lot of people trying to do it. So we're going to see how easy it is to actually get it done. But
so question for you, Jeb.
Yep.
You just very recently added to the marketing, the MLS, stating that it is VA, and George was willing to have it be assumed. How did that change the activity you were getting on it?
It took 2 buyers who weren't 100% committed to the property, I guess is the right word. They had some hesitation about making an offer because of the proximity to a street. Add that into our list of things that buyers don't want, and we took the pool down even further. So we could tell you a lot of stories about this whole thing, but nevertheless, once I told those buyers, hey, listen, there's a VA loan on this thing, which I remembered after about a week or 2 on the market. I was like, you know what? There's a VA loan on this. It's assumable. And went back to these. Guess what? Interest changed. That 2.25% changed the mindset of both borrowers that are considering that property because of how low the payment is. So it's a big difference in the monthly payment.
Alexis is still here.
Yep.
VA expert, and pointed out correctly, no appraisal on VA assumptions. So if you find yourself in that situation as a buyer, you don't have that. So your realtor is going to guide you through on what comps are available and make sure you're not overpaying because again, because that down payment is required, the loan is already in existence. There's no reason for the VA or the FHA to require another appraisal.
Good. All right. Awesome. Real Estate Curious Josh has a question about retirees. How much do underwriters consider one's assets instead of monthly income? So Josh, talk about that because this is often something that's misunderstood when it comes to underwriting.
If you're of retirement age, the assets are not going to really be helpful for most loan programs because reserves are not required. So if you have a substantial amount of money and it's sitting over in reserves, it's like, cool, you have the money, but we're also most concerned with how you're going to make that monthly payment. Now, if it's in a retirement account, once you're of retirement age, because you can pull from that, we can do a couple of things. We can set up distributions. We can annuitize that income. Fannie, Freddie have different guidelines. Jumbo loans have different guidelines. So very important if you're in this stage of the process to talk to a lender that knows and understands those guidelines because you can turn those assets if they're substantial. And what's substantial? If you're buying a $50,000 house, $50,000 is substantial. But $200,000, $300,000, $400,000 in retirement assets. There's different ways to make that into an income stream to help you qualify as well.
All right.
Good. Let's just because we're still kind of on that assumption. GD points out for an assumable loan, VA loan, ensure the buyer has enough entitlement to assume the loan, and what he means to substitute their entitlement for yours. In your situation, Jeb, George isn't going to buy again, so he doesn't care. He says, bring anyone. A non-veteran can assume a VA loan, but they don't have any entitlement to substitute for the veterans. So the veteran's entitlement is going to still be used up for whatever amount of it is used up on the market. Doesn't mean they can't buy another property. You have bonus entitlement, secondary entitlement that you might be able to buy something, but it may mean that you need to make a down payment if you're trying to buy and whoever assumed your loan didn't substitute their entitlement.
All right, good stuff. MQ says Powell has said in the past he watches JOLTS more than the jobs report. Maybe we get a July cut? Asking the question mark. At the moment, probability doesn't show July. What would have to happen in order for a July cut to happen, Josh? You would need the dismal jobs report that I mentioned, not only this month, but probably next month as well. You would need really bad data because the cuts, the meeting's not until the 31st of July, I believe you said. So you've got a lot of time between now and then. Almost 2 months between now and then. Could it happen? Absolutely, it could happen. But at the moment, it's not seeming, it's not looking like a possibility just based on recent reports.
Two jobs reports before then and 2 CPI reports before then. So you would need right now. So I forget, one of the regional feds does a nowcast on inflation, month over month inflation, and they are showing they finalized out May at 0.08. So if we get a 0.1, I still think that's negative for this coming month. Don't we have a zero dropping off, Jeb?
We don't. I thought we did, but I don't think it's a zero. I think it's higher than zero.
Okay, we hope so because it's going to be a low number. But if it's not, more than 0.1, it's not going to show really any improvement because it's that rolling 12-month total.
I'll look it up. When you answer a question here in a minute, I'll look to see what's coming off.
So their final number was 0.08 for May. And so we're only 5 days into June. They're at 0.14 right now. And as every piece of data comes in that trickles into CPI, they kind of adjust that. So hopefully we keep seeing those lower numbers. We keep seeing used autos going down. We're seeing all of the measures of rent slowly coming down, just much slower than anyone wants to see in terms of improving that inflation data. But you ask what would it take for a July cut? We'd have to have 2 really benign CPI numbers and 2 really weak jobs reports.
JV says, is it fair to say that buying an investment property in California will not cash flow in a case where you put the minimal required down payment? If this is the case, why are investors still buying them? So I think that's an accurate statement. In most cases, why are investors still buying them? Because when you invest in real estate, you typically invest one of 2 ways. You invest for cash flow or you invest for appreciation. So a lot of investors don't put the minimal down. they put more than the minimum down because they're banking on that property cash flowing based off how much they put down, right? So it still might cash flow in their eyes based off their down payment, but they're looking for appreciation long term. So it's kind of a twofold for a lot of investors. Some investors are looking to flip property, right? They buy it all cash, turn around and flip it. It just investors, there's so many different styles of investing. Short-term rentals, in some cases, short-term rentals can produce large amounts of cash flow just based on a much smaller down payment because of the type of investment it is. So it's not don't lump all of them together. But there are definitely opportunities out of state for more minimal down payment on investment properties to cash flow than say California. Absolutely.
Minimum down, just it's not a thing when you get to highly appreciated areas. What we see a lot, Jeb, is people just rotating properties. Someone highly appreciated Class B property and they want to get into a Class A property, or they want to get something closer to their home, or they have a 12-unit apartment building and there's enough equity in there that they can pay cash for a 4-unit that's easier to manage. There's more to it. This is a very difficult market for someone to say, I'm going to become an investor in real estate, especially with the minimum down per the guidelines. I mean, on a conventional single-family residence, you can do a 15% down non-owner. With that, the rate would be somewhere around 8.5%. You'd have mortgage insurance close to 1%. And you look at that and you're like, yeah, no, thanks. I mean, you're way upside down on your monthly.
Good stuff. I just put a banner on the bottom of the screen, giving you a referral link. If you need to get in touch with Josh, like to get in touch with myself, want to get in touch with a real estate agent, mortgage broker, anywhere in the country that does business like us, that link will get you there. In fact, you'll probably be working with us for the majority of the time. And then we'll hand you off to somebody that can help you if we can't serve your area. Hung went in and said, HOA plus land lease payments. There goes my beach living dreams, and gave $10 for the mic. So now I feel like I have to buy a mic since people are giving me money towards
They're going to expect
otherwise it's
mic.
like, yeah. So, I guess I have to buy a mic. That's a good start. $10. Thank you for that, and appreciate it. So I'm assuming we were on the same page with what I was talking about. Land leases are not for me. That's what I'll say. Some people are okay with them. So don't let my comment persuade you 100%. Just, I think the 1-bedroom thing should persuade you more so than the land lease thing. Because the land lease is
I would buy a 1-bedroom before I'd buy something with a land lease.
Well, that land lease is really well plus years
at
this point. So that's not you're not going to risk losing that property in your lifetime. Probably it is, it is expensive because of the two, but I think, but to each his own. You got to decide what's right for you. Fig love makeup. Fig love makeup. It should be figs love makeup. Like, I feel like we need something plural here. I feel like we're not missing the plural part of fig.
Some letters missing.
Like fig. Yeah. Anyway, are FHA appraisers the same as other loan appraisers, Josh? So what makes an FHA appraiser different, I guess, is the better question.
There's not. They just need to know the requirements. So a trained appraiser can do an FHA appraisal, a VA appraisal, a conventional appraisal, and most of them do all of them. Conventional and FHA appraisals are all done through appraisal management companies. A large lender could have their own appraisal management desk. The purpose there is to firewall the salespeople from the appraisers so they don't get unduly influenced. So for that purpose, I don't know of anyone that only does FHA or only does conventional. Most of them do both. And most of them also do VA, but VA handles the assignment of the appraisals themselves.
All right. I got a couple questions here. Ted says, appreciate the insights. I'm thinking of moving in the next few years. As a current homeowner, what should I plan to save for moving costs, agent fees, buyer's closing costs for both transactions? So difficult to say at the moment, right? So there's a lot of changes happening in the commission world, in compensation. So that could very well change over the next couple of years. And if that does happen and it becomes the new norm, then what you're paying as a seller will be less on the sell side and you'll have to pay more on the buy side. But nevertheless, I would think, when selling a property, depending on what you decide to agree to compensation with your agent, add about 1% on top of that in other fees that you're going to have to pay between escrow, title fees, just, city tax, just all of these different things at about 1%. And it's going to be less than that in most cases. So hypothetically, say you agree to commission of 4% with your agent where, they're getting to, the other agent's getting to, I would say factor in about 5% total of what you would pay. But an agent can always get you a seller net sheet prior to ever selling your home to give you a really good idea of what you'd actually walk away with based on a certain price. So I would say more so go that route and use that as, more of the gospel than asking me here without having any insight on the state that you're in, the property that you're selling, all of that good stuff. And it's going to vary by state. It's going to vary by agent. All of those things are going to be a factor.
It's going to vary a lot by state,
Yep.
Jeb. We're very lucky here in the Western United States. That's all pretty similar once you get west of the Rockies. You get up in the Northeast, some of these transfer taxes are bonkers.
Yes, bonkers. Patrick, I feel like he asked this question earlier, and for whatever reason we didn't click on it. I don't know. But
I thought you said you don't like Patrick.
I did. I said I don't like Patrick. Patrick, I'm sorry, man. I don't like you. No. I have no idea where that came from. I said horrible tenants versus squatters. Is it the same timeline in terms of getting eviction? Any new laws for helping landlords in the work? So depends on your state. California is very, very tenant friendly. And with that, squatters kind of fall under those tenants to some degree. I'm not familiar enough with eviction laws on squatters tenants to be able to tell you if they're the same timeline or not. But what I can tell you is that both are difficult in the state of California. There's some crazy laws here. Like if somebody moves in and paints or does something on the inside, like they've improved the property, then that gives them even more right. I mean, I've heard crazy things. I don't know if all of that's accurate, but
you say even more rights, but the only rights that a squatter would have is tenants' rights. They're asserting they have tenants' rights. I don't see any world where they could have more, but they're generally, if you see all these news stories, they're showing up and saying, look, here's my lease. I'm a tenant. So I don't think it's any worse, but I don't think it's any better either.
Yeah. And honestly, like it changes so much. I mean, I will say the horror stories that you see are made to be like, hey, this is what's really happening, or this is happening everywhere. Whereas those cases do happen, but they're in the minority for the most part. That's not, it's traditionally what happens. Most people renting a property, landlords don't have to deal with that. But those that do, I feel sorry for them. It's a pain. Let's see, Josh, we had a couple more here. Scott is asking, are we still seeing a decent amount of Californians coming to Arizona? So we don't know. What I will say is on average every year, I have probably 4 to 5 clients move out of state. And some go to Arizona, some go to Texas, some go to Tennessee, some go to Florida. Traditionally, what happens, and this is not a political statement, but this is what happens, is that most people leaving California are going to a more red state, something a little bit more conservative, where taxes are a lot less, housing prices are typically less. It's in many cases, it's not only a cost move, but it's a political move. So I don't know if there's still a decent amount headed to Arizona, but I would say it's definitely probably in the top 5 of people leaving California. Arizona is definitely in that list. Ed says, Josh, we've talked about this on the podcast before, but do you think the silver tsunami will greatly increase supply in the next 10 years?
Not greatly. The data is out there, and we reference it in that episode of the podcast. So if you truly are interested, go back and dig it out. There's some really good studies that have been done. And I forget the lunatic lady's name that keeps ranting and raving. First, she was on and on about silver tsunami, and then it was young men not having sex, and both were going to cause the housing market to crash. The silver tsunami is real. It's not made up, but it is not enough to make up the shortage of homes that we already have. So it will increase supply, and it'll increase it at a greater rate the later we get into. Good Lord, Jeb, there goes the damn light.
I love it.
So the later we get into this decade, there will be more and more homes coming available. So it's very slow until about 2027, and then kicks up for the next 5, 6, 7 years after that. And it will help. It will help supply, but I don't think it's anything that's going to crash the market.
Well, understand. I mean, this is my take on that. It will increase supply. All of these properties aren't necessarily going to come up in the same areas at the same time, right? So that's why you don't see a big drop in prices in most cases, unless you have it happen in, say, a Palm Springs or the Villages in Florida, or an area that is highly, highly concentrated with an older demographic. In those markets, could I see something like that having an impact? Absolutely. But a lot of it depends on what the kids decide to do with the properties in many cases, right? Because what's happening is the next generation is being handed, I don't know what the number is, Josh, like something billion,
Trillions.
trillions, what's the word I'm looking for here? What are they getting handed? Inheritance. Yes. But it's essentially a transfer of the largest transfer. That's what it is, of like assets from one generation to the next. And if kids decide to keep these and turn them into rentals, then they never hit the market. If they decide to live in them at some point, because maybe it's not in a retirement community, because maybe they never were able to afford a home and this is the opportunity for them to keep a property, then that never hits the market. So you're going to have all of these things being part of that equation. They're not just all going to hit the market. The question is how many and how often and where, and those are the things you got to worry about. So I wouldn't be sitting here on the sidelines waiting for that to happen. But it could have an impact. We will see. Sammy, Josh has a good question. As someone who's purchasing in SoCal in July, why July, Sammy? Why not before? How will the NAR settlement affect my representation? So in July, it's probably not going to affect it quite as much. It's supposed to happen in August is when it's initially going to be signed in be in effect. But what's going to happen is you're going to have to sign a buyer broker agreement, basically going forward with as part of the settlement. So when you meet with an agent to represent you as a buyer, there's going to be an agreement that has to be signed with regards to compensation. That's new. There's a chance that compensation is still covered by the agent on the other side. There's a chance that it's not. There's a chance that part of it is, part of it's not. It's all a negotiation, but that's something they can walk you through. But that's really the conversation at hand there. I've done videos on it on my channel about my thoughts on it. If you're interested, go check them out. Josh, we got somebody asking, is it better to keep a rental property that rents for $3,100 per month or sell for $600,000? So I'm assuming at this point they own it free and clear is the way I'm getting this, and invest in the stock market or other investments. I pay $5,000, never mind, $5,000 property tax, repairs, and 7% management fee. So $5,000 property tax per year, I'm assuming, and a 7% management fee. So yeah, they probably own it free and clear. Would you keep 3,100 or would you like the 600,000, Josh?
So I look at it, you have to take the numbers here and say, what is my net? What is my net spendable income? So what is my yield on that asset? So if after all of that, we got 400 in property taxes, say there's $100 in repairs, 7% management fees, $200. So say you got $700, well, you have $2,400 that you're walking out of there, about $30,000 a year. If 600,000 is what it's worth that you could walk away with, then you're getting what? A 5% yield on that. There are other advantages because you have 5% spendable yield right there. But if that thing goes up 3% a year, you got another 3% on top of that. You have depreciation. So you have some of that income shielded from taxes unless you've completely and fully depreciated that property.
That's 600 is not 600 if you sell it, right? You got costs, you got all of those things that you got to factor in.
Yeah. So that's look at your yield, look at your cash, and look at how savvy you are at other investments. I will say this, I have done very, very well investing in real estate and very, very average investing in the stock market. So for me, I know where I have an advantage, where my knowledge and skills can put me ahead. We've talked about it on the show. I have a property in Orange that I bought in the middle of the pandemic, been great buy, fixed it up, and it's got a 3% mortgage rate on it. Like I look at that and I'm like, I couldn't sell if I wanted to. The cash flow on that, based off of having bought it at a really cheap price, we're in California, so the property taxes are very low, interest rate is very low. It would be really difficult to say, hey, I can walk away with $350,000, but walk away with $350,000 and do what? I don't feel like I could get a similar yield on it.
All right. Rickolas Cage, regular viewer on here, says, looking to sell my home in Texas, and I'm looking for a real estate agent. Came across someone who quoted me at her rate 6% commission. That seems high to me. Thoughts? So here's what I would say. Can't really comment on it. It's considered collusion, but get another opinion. Talk to a couple different people. Compare what one agent provides versus the other, what they're charging, and make the best decision for yourself. If you need a referral, I know a lot of agents in Texas, depending on the market. So reach out and I'm happy to put you in touch with somebody that you can compare it and see what makes sense. Josh, we had another comment here and
this is probably not the one you're looking for, but while you find it, Maddie says, where I live in California, half the houses being sold are dated fixers whose owners lived there for decades and their kids just want to sell. FYI, the kids are the boomers, not the parents. That's the funny thing. When I hear people licking their chops that their parents are going to leave them a bunch, my grandma I just talked to last night, she's 94 and going to be around for quite a while. My mom is 72. I expect she'll be around as long as my grandma. So when my mom shuffles off this mortal coil, I'm going to be about 75 years old. I'm not eager to be 75, even if there's going to be some inheritance from my mom. So that's the reality of it. People are living a long time. Not that there aren't people that die when they're 65, 70, 75, and their kids are 50 or 55. But a lot of that is true, that you're seeing much older folks inheriting property.
Nope. Good stuff. Felipe says, hey guys, I have a question. Is it a good move to sell my condo in Newport Beach right now and buy new construction given the interest rate? Impossible to say. Felipe, don't really know the goals here. Don't know what you're trying to accomplish. Don't know what you're giving up. Do you have to move? Do you need to move? Is it a family time? Like a family reason? How long are you going to be there? All of these things are going to factor into that decision. Just a matter, how all of those things line up and whether or not it makes sense. For some people, it does make sense. Others, it might not. I mean, I sold a property in November that had a 3% interest rate on it. And I bought a property that had a 7% interest rate on it. Was that the right move for everybody? No. Was it the right move for Jeb? To be determined. But as of now, it's the right move. We're happy
in 5 years.
Yeah, we're happy in the house. We're, where we are. We've got plenty of equity, all of those things. It was a life decision based on family. It was the right time because of 3 boys, because of my wife, because of where we are in those stages of life that we wanted to be where we moved to, and so be it. But all of those things that we talked about are things that I'm comfortable with and made the decision based on that and not tried to time the market on either side of it. It was just what happened. But if you need help about, you got specific questions about that property, don't have an agent, reach out. Would love the opportunity to talk in a little bit more detail. Javier loves the Mr. Javier. You guys all know Javier, I'm sure. Javier is what I consider an old school YouTuber. He was on here, talking about first time home buyers when you could actually help them. Now it's very difficult in many cases, even in his market, which is in the Phoenix market. So it's changed considerably, but good channel, a lot of good information. Talks about a lot of stuff that people, need to know when buying a home. So check him out if you haven't done so. Josh, here we go. When you're doing a pre-approval, do you consider the amount of taxes I pay quarterly? So I'm assuming this is a self-employed borrower. They pay quarterly taxes. Do you take that into consideration when you're looking at their taxable income?
No, because we use gross income. So if you were a W-2 employee, we don't look and go, hey, how much are the withholdings there? We're looking at your total income. The only difference there is with a self-employed person, we know the gross revenue, but then we know there's expenses with the business. So it's the net profit, net of expenses, but pre-tax that is used for qualifying.
All right, good stuff. Been on an hour and 3 minutes. Josh, do you see any questions here that you absolutely are just dying to get to?
Good, quick, easy one. Earnswell Rod says, when rates start going down, will lenders still refinance if you only have $80,000 on the loan amount? Someone else had commented that many lenders do have a minimum loan amount. The problem is once they get much below 80,000, definitely 50,000 and below, very, very hard to do them in a compliant way because the government set a maximum that can be charged on a loan. And many of these charges are fixed. If you have a $250,000 house and you get a $200,000 loan, the appraisal is going to be $500. You get a $50,000 loan, the appraisal is $500. So one is 0.2% and one is 1% of your loan amount. So you start to see how it can get problematic in terms of the charges. The biggest difference is with those smaller loan amounts, you need a much bigger difference in the interest rate to make it worthwhile. We talk about it on the show here all the time, Jeb, that 125,000 divided by your loan amount tells you what you need to save. $80,000 loan, you need to be like 1.5% savings. So if you got that when rates were a little better, maybe at 6.5%, you need rates all the way down at 5% before it can even justify the cost of that refinance. So yes, you can do it. The calculus for if it makes sense is going to be very different.
All right, Josh, we're going to throw one other up here just to, because rates are a popular question all the time. GD in this case is not closing until June 24th. So what, 3 weeks, basically, a little less than 3 weeks. Seeing mortgage-backed securities rallying down with reports coming in the next weeks. Should I lock now at a 6 1/8 interest rate or basically float it and see what the market hands me?
I want to see what that NFP looks like on Friday. I don't think we get such a hot jobs report on Friday that it crushes the market. It could get worse. You could lose 1/8% in a day. I don't see it losing 1/4 or 3/8 in a day. I'm willing to see that. If we go back and pull up the chart, that yellow line, that 200-day moving average, I want to see if we get below that 200-day moving average. If it gives way, there is a clear and not easy, but a clear and direct path to almost a 0.5% improvement in interest rates. It's not a guarantee. We saw that a few weeks ago. We're going to see more confirmation and data in terms of improving inflation, worsening jobs. So I would want to see, I would want to get through Friday. If you see a big improvement, you may be interested in locking because again, next Wednesday you get the Fed talking and CPI, but you might be at the same point. Say, hey, rates dropped 1/8 and I'm now looking at 6% because of Friday's jobs report. I'm playing with house money. Do I want to roll it through and see if next Wednesday we get another 1/8 or another 1/4 and maybe you're looking at 5 3/4 or 5.875 instead of that 6.125. It is a matter of risk tolerance.
Don't get greedy. Don't get greedy.
It's not a matter of getting greedy. It's a matter of understanding, set your stop loss, know your risk tolerance and set your stop loss. Like if you're considering locking right now, you don't want it to get worse. Say, am I comfortable getting it 1/8 worse? And as soon as that thing hits 1/8 worse, lock it and move on. So if you want to move that sort of trailing stop down as the market improves, if it improves, go ahead and do that.
Josh has recently started to trade stocks and now he's talking trading. Just don't even listen to him right now. He's trying to show you multifaceted Josh. Just the reality is
we're going to start talking about golf here shortly.
If you're a gambler, gamble, baby. Last question for refinances. Is it normal to see payments go down, but the remaining mortgage balances remain almost the same? Joyce, we talked about this in the Educated Homebuyer this past week. Refinancing 101, basically walking you through the entire process, what you need to pay attention to, what you need to avoid, more importantly. So hopefully that helps. Go over to the Educated Homebuyer podcast and check it out. Like and subscribe if you haven't done so already. It helps the algorithm, helps Josh and I. If you want to get in touch with Josh, myself, there's a referral link scrolling in the bottom there. Until next week, guys, we'll still be alive. We'll still be here. We just won't be on the interwebs until next week. All right. Until then, adios.
Amigos.